Welcome to Thorgood Tax Talk.
This is Thorgood Tax Talk, where we break down real-life tax issues and the mistakes that turn into legal trouble. I'm Evan Mack with tax attorney Shamsey Oloko of Thorgood Law. Shamsey is a criminal tax defense attorney who represents clients in investigations involving fraud, tax evasion, and IRS enforcement. Today, we're unpacking the most common and costly mistakes people make with their taxes and how to avoid becoming an IRS case study. Shamsey, welcome back.
Thank you very much, Evan. Good to be with you today. We're talking about my favorite topic, taxes.
This is top tax mistakes that can land you in hot water. So, Shamsey, what is one of the most common tax mistakes that gets people into serious trouble? What have you seen throughout your illustrious career, sir?
Thank you very much for that question. By and large, the biggest challenge that people have is underreporting your income. If you underreport your income, you're almost likely going to have difficulties. Next to underreporting is underpaying or overstating your deduction. Underreporting your income, let me break down just a little bit, into a little bit of details. So if you get a W-2, it's 1099 or what have you, by definition, that form, the government has a copy. So if you don't show income that matches what the government knows, the computer will flag you and say, hey, listen, Evan is not, owning up to his full income. And they come looking for you. So that by and large, that's by far the biggest source of, getting into trouble with the IRS. People tend to be creative for different reasons, underreporting their income. You ask for an example. I'll give you one example. It's a bit of a story. So there's a taxpayer who has he has an original problem, which was that he had undocumented workers, but he needed those workers.
Mm-hmm.
So, and he needed to pay them, and he needed to deduct the cost of paying them. Well, if you cannot report that you have these workers, then you cannot deduct the payment to them. So what the taxpayer was doing was he would take all his income, if you pay him with a check, 10 grand, 50 grand, he would go to check cashing place, collect the cash, and pay the workers.
Wow.
So that whole money is out of the system, if you will.
Wow.
Except for one fact. The check cashing place has to send a report to the government on all money or checks that are cashed.
Mm-hmm.
So that does result, because there you have all kinds of problems. You're evading taxes, you're not withholding payroll taxes. I mean, there's a host of charges, and you'll be prosecuted criminally if you do that.
Shamsey, where do you think that mentality comes from? When I was growing up, it was always, I don't feel like I have to pay taxes, it's my money, you know what I mean? Where do you think that mentality comes from as I used to hear that so many times, and I still kind of hear it from different places, you know what I mean? Do you have an opinion on where that comes from?
Well, people generally don't like to part with their money.
Yeah.
Especially, because once you give it to the government, you no longer have control over the money.
Uh-huh.
So people tend to naturally look for a way to not pay that money. And what compounds the problem, in my opinion, is we have a self-reporting system. The government lets you, Evan, decide, hey, listen, how much money did you make? You tell us.
Uh-huh.
But unbeknownst to you, the government has a rope. They know how much you made. They just want to see, are you going to tell the truth about how much money you made?
Mm-hmm.
So, and people get caught. People get there's an untold story in that. So the IRS has a guy, an agent that they pay, X amount of dollars every year. Well, so if IRS thinks that Evan is underreporting, and if you go after him, we can get $2,000 from him.
Mm.
The government may say, all right, let's leave that alone. However, someone said they gave Evan $500,000 last year, and he's not reporting that money. Oh, if I go after him, I can get $200,000 from him. It's more worthwhile to go after him.
Mm-hmm.
Sometimes, as it happens in many cases, if there's a spate of underreporting being done, and there's the common element is a tax preparer who's helping to make all these funny tax returns, they will go after the preparer, because if they take him out, it's more likely that more of those taxpayers will comply going forward.
Mm-hmm.
So it's a bit of a system-wide thing.
Mm-hmm. We kind of talked about it on a different episode, but how do simple errors like filing late or underreported kind of escalate into legal issues?
Well, okay, so filing late, as a technical matter, if you don't file your tax return, the law sees that as you filing a tax return with a zero income, which would be a lie. So then that would be tax evasion. So that's a crime. That's a felony. That's a federal felony. And it's the same thing for the state. Underreporting, by definition, you're evading taxes.
Mm-hmm.
That's why you're underreporting. And those things, if it's a small scale, because again, it goes down to, is this a pattern? Have you been doing this for some time? Or if it's a one-off, let's say, you filed every year except for the last 2 years. The government will usually just send you a letter and say, hey, Mr. Mac, you haven't filed returns for the last 2 years. Usually what they would do actually is they will file a tax return for you
Mm-hmm.
and then send you a bill. Now, what's important for this episode actually is to know that if the government files a tax return for you, they will always file it in their favor. So let me give you an instance. Let's say you bought, I don't know, IBM stock
Right.
for $2,000. When you sold it for $1,500. You actually had a loss of $500. So your broker is going to send IRS a tax statement that says, hey, listen, Mr. Mac sold his IBM stock for $1,500.
Uh-huh.
And that's it. So when the IRS decides to file a tax return for you, they will show an income of $1,500 when you actually had a loss of $500.
Wow.
So it's incumbent upon you to come back and say, whoa, 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 time out. I did not make money on that. And the way to avoid that is to file a tax return in the first place.
Incredible stuff. What's the danger though of commingling personal and business funds? I know we talked about it a little bit, but what is the danger of kind of robbing yourself to pay Paul? You know what I mean?
Well, okay, so first you're not supposed to do that. And when you do that, the longer it goes before so for instance, let's say for tax year 2024, that the tax return for that year is not due until April of 25. If it's April 25 and you're trying to recreate in your mind what you did in January 24, you're likely to run into problems if you commingle your funds, because the identity of the funds is lost. So you find yourself, deducting, personal expenses, as a business expense. That's a problem. And vice versa. So commingling is bad in every instance. You should always separate your, personal money from the business money. And also, if you ever run into an audit and the agencies that you are commingling the funds, that's usually a red flag that there's something wrong. It may be innocent, but there's something wrong because you're committing the funds. Because and the agent's not going to like the fact that they have to now sift through, all the expenses to figure out which one is yours and which one is the company's. So it's always bad practice to commingle the funds.
What about your bookkeeping? Can poor bookkeeping or relying too much on maybe a CPA, can it lead to bigger problems?
It can, in many instances. In many instances, I've seen, running an audit, and the taxpayer says, "Hey, listen, all I did was I had my CPA prepared there and I sent it in." However, let me just take it real quick. At the back, just at the top of every signature block in the tax form, there's something called the jurat. The jurat is a language that says, to paraphrase, it says, "I, Evan Mack, under penalty, subject to the penalty of perjury, affirm that the contents of this tax return or this form is full, correct, and complete. There's no exception for if my SCPA messed up. It's yours. So if there's a problem with that form, it's entirely yours. So
Mm.
the antidote to that problem is to keep a close eye.
Okay.
The responsibility of that tax form is yours and yours only. So you want to be able to like ask taxpayer your CPA the question, hey, listen, what's that? Uh, Literally a month ago, I had a situation where a taxpayer who's a professional doctor, um, there was an audit, and the government says, "Hey, listen, you had a business and you had a loss." Now, the taxpayer was smart enough to call me instead of calling the preparer. And I said, "Oh yeah, it says here that you have this other business." He goes, "I don't have a business." Well, your tax return says you have a business. I do not have a business. Well, so that's the preparer improvising, which is illegal because you're lying. So what you do in that instance is we have to go back and amend the return and excise that false thing out of the case. So the resolution was harmless, but it's not always going to be harmless because you are responsible for the tax return. Now,
Are there red flag deductions that increase your audit risk?
yes. The biggest one is if you are a salaried employee and you have business expenses, that's a problem because
Mhm.
you're not supposed to have one. Many times I see, again, it could be it's usually the preparer trying to improvise and trying to get refunds. It will say, "Oh, you had a side business, and the side business is always losing money." So if you keep even if you run a business, and if you repeatedly keep having losses, IRS will think that's a hobby, that's not a business. So that's usually a red flag. Uh, there's some expenses that the IRS, always tends to question.
Right.
One of them is deduction from home office. For some crazy reason, IRS, just seems to have a problem with that. I mean, if it's true and you had that, expense, then if they come to you, then you give it up.
So I think that one of the scariest things is, about this is kind of like that criminal investigation or being criminally liable or going to jail. So I think that fear is always is prevalent. But what's the biggest mistake you've seen that could lead to a criminal investigation?
Well, IRS writes to you, or IRS thinks that, hey, listen, you've engaged in knowing, tax evasion. That's a huge red flag. Um, and at that point, and I want to say this very carefully and clearly, you should not talk to the IRS without your lawyer being present. You should not. In fact, the telling point is IRS will never talk to you without somebody else being present. IRS agents always come in pairs. If you talk to them by yourself, there's a big problem. So that's number one. Because there's no upside to you talking to the IRS by yourself.
Okay.
The second issue is because when you talk to the agent, you might say something that turns out to be false. Lying to a federal agent is a crime, whether you actually did something wrong or you didn't do something. The last point I want to make on that issue is, and because I've seen this happen repeatedly over time, if you're telling the truth, well, there's usually going to be IRS, as with most law enforcement agencies, they're not interested in the truth. They're
Mhm.
in what they can prosecute successfully. So, what's the truth or not the truth? What's viable? What's not viable? You should leave that to your lawyer. Let them
Okay.
decide. Because many times, if the government says, "Oh no," and they will say that, but if you just tell them the truth, you don't have a problem. Well, it's like when you pull the string on the skirt and the whole thing can come off.
Right.
Yeah. So only your professional who's there specifically for your interest should be the one that decides, hey, this is what you tell the IRS, this is what you don't tell the IRS.
So Shamsy, how do these problems differ between individuals and small businesses?
So with small businesses, if the small businesses is being prosecuted, it's usually going to be fines. You cannot put a business in jail. individuals could go to jail, and many times we end up in jail. The hybrid point is where the government can prove that the malfeasance or the wrongdoing by the business is a consequence of the individual owner, in which case the liability comes back to you, and you end up, having to pay for that.
So can people fix these mistakes after the fact, or are they kind of stuck in the situation that they're in, Shamsey?
They can fix the mistakes. That's when you bring the tax lawyer. Yeah, you really you got to cut your losses. Once you realize that there's a problem, as soon as possible, stop talking. It's your constitutional right to stop talking and reach out to a lawyer.
Okay. And what's one thing every taxpayer should do this year to avoid these landmines and these problems that we've discussed?
Records. Keep good records, keep excellent records. Make sure that your records is consistent with what's being reported on your behalf on the tax return. You want to be sure that, hey, listen, because if your preparer is telling the government that you have, a water filtration system, and you don't even know what that is, and it's on your tax return, you are responsible for that. So you got to be bold enough, diligent enough to ask your preparer questions about that tax return before you sign it, because you are responsible for it.
Wow. Shamsey, thank you so much for the information and thank you for your time.
Evan, thank you very much for being here this morning.
If you're worried if you made one of these mistakes or you want to prevent one before it happens, visit thorgoodlaw.com to get answers, subscribe, and leave a review to help others avoid these same traps. Thank you so much for joining us.
Thank you, Evan. Appreciate your time.
Thanks for watching. Be sure to hit that like and subscribe button and leave us a review in the comments.